Hey, what's up, family? This is Marseille, the property pastor here with Kingdom Legacy Builders, where our mission is to help everyday people like you and me to build a lasting legacy for our children and our children's children. I'm here to build your faith. I'm also here to help you build your finances. You know, the Bible lets us know that a good person, a good man, a good woman, they build an inheritance for their children and their children's children. So I want to teach you how to do that today. And I want to talk specifically during today's video about how do you use a home equity line of credit to invest in real estate. So real quick, I want to give a shout out to my man, Eric Murillo, who posted this question recently on the channel. Eric, I thought it was a great question, so I decided to do a video about it. So I hope this answers your question, but I hope it also helps somebody else. And I want to talk about two main ways that we're going to do that. And the first one being using it to buy houses using all cash, or using it to fund down payments. But before we get started with the video, if you haven't done so already, make sure you hit the subscribe button. Make sure you subscribe and follow the channel. We're bringing great content every single week. Like I said, my mission is to help you to build not only your finances, but also your faith. And God has blessed me to build a portfolio over the past 5 years of nearly 15 properties, well over 30 doors, and it's truly been a blessing to me, and I want to be a blessing to you. So I pray this content helps you along that journey. If you have a home equity line of credit, if you're looking into starting one, I want to help you to put that to great work. That's something that I did in my portfolio, in my journey, and it's helped me to build my portfolio and to scale it. For this, let me explain what a home equity line of credit is. A home equity line of credit is a product that banks offer where you can tap into the equity of your primary residence. So let's say, for example, you got $100,000 of equity. In other words, your house is appreciated over time. You've been paying down your mortgage every single month, and now you've got what we call equity. The difference between what you owe and the difference between what your house is worth is called the equity. So if you have that equity, most banks will give you essentially about 75%, sometimes 80% or more of the value of your home. So they're going to require you to leave a little bit in there, but they will actually allow you to take out a home equity line of credit to do things that you want. Some people use that so they can go and, take trips. They do it. They want to make improvements to their house. But I use my home equity line of credit to actually invest in real estate. And one of the things that you got to remember about a home equity line of credit is that typically the payments are interest-only payments. The benefit of it is that you're essentially going to be able to borrow money and use that money and only pay interest on what you borrow. Now, in today's example, we have a $100,000 line of credit. So what that means is that the bank will give you a line of credit that you can draw from at any given point in time, but you only pay for what you withdraw. Now, if you refinance your house or you put a second mortgage for that same $100,000, you are going to be paying that off immediately. So you have principal and interest payments in the form of a second mortgage from the day you open that loan. But with a home equity line of credit, if you're out looking for property, you just have available money. I call it like a credit card, basically. You get a credit card, you're able to tap into those funds, and you only pay for what you use. But again, it's interest only. Now, what I do is I treat my home equity line of credit just like a regular loan. I calculate in what I want to pay for principal. So every single month, instead of just paying the interest portion, I add principal on top of it. So I treat it just like a normal type of mortgage. But the benefit of it is that I'm only paying on what I take out. So I want to compare those two different vehicles. The very first one is, should you use your home equity line to buy multiple properties with down payments, to fund down payments, or should you try to do all cash purchases? Now, both of them have pros and cons. Now, the first thing that I want to talk about, and we're using a basis of $100,000. And my recommendation as I use the two is I would prefer to use my home equity line of credit to fund multiple deals, the down payments on those deals. And I will tell you why. Again, I've done both of them, but the reason that I would prefer and I recommend using it for down payments is because you can buy a lot more real estate that way. Now, let's say, for example, you got $100,000 of in a home equity line of credit. Your HELOC balance is $100K, and you could either buy one house for $100K cash, or you could buy basically 5 houses with $20K down on each house. I would go for the 5 houses every day of the week. The reason is you want to be able to scale faster. So you want to buy as much real estate as you possibly can, because you're going to get the benefit of your tenants are going to be paying that debt down for you every month. You're getting the tax benefits from 5 houses, the depreciation on those 5 houses. You're getting more cash flow from all 5 houses. It just allows you to get there way faster. But I want to really break it down because there are pros and cons to each method. So let's say, for example, we use our 100K and we go out and we find five houses. Those 5 houses all at 100K each. So their purchase price is $100,000. And now we're going to go in and say, okay, each of those is going to require 20% down to buy. So I'm able to take my 100K, buy all 5 houses because I'm only putting 20% down, and now I've got 5 homes. Let's say, for example, though, that each of those houses are making $300 in positive cash flow per month. I've now got 5 houses making me $300 per month, or $1,500 total positive cash flow. Now each house is probably going to make less positive cash flow, and the reason is because you're going to have your down payment from your HELOC. You got to pay interest on that, but then also you're going to have your principal and interest payments on your primary mortgage. So now you just financed that home with a HELOC, and you got to get the bank to give you that regular mortgage. So your cash flow is going to be lower, but you've now got 5 homes. So over the years, those 5 houses are going to appreciate, 3 to 5% per year. And that's going to give you way more wealth in the long term and going to allow you to scale much faster. Now, on the downside, it can be a little bit tricky because the HELOC is also going to affect your debt to income ratio. So as you look at your debt to income ratio, right, your HELOC is a line of credit and it's showing a payment that has to be made. So some of your traditional lenders, they may ask you questions about, what is this HELOC over here? They may want to see the funds moved over. I have had that happen before where they want me to transfer funds from the HELOC to the actual account where it's going to come from. But as you gain experience, that happens less and less. So it really depends on your lender, but that could be one of the things that could slow you down a little bit. Is just your debt to income ratio could be affected, just depending on how your HELOC is set up, depending on your specific lender. But by far, this is my preferred method. Now you also have the all cash option. Now my very first property that I purchased, I paid all cash for it. I bought a quadplex. I spent about $65K for that property. And then over time I did some rehab to it, refinanced it out, and I got all of my money back. The thing about the all cash option is on the property that you buy, you are going to get a higher monthly cash flow. The reason for that is that you're only going to have interest only payments. So in that, if you buy that property with interest only payment, your cash flow, instead of being at $300 like the other example, you may be making 6 or 7 because your payments are only interest. They're not based on principal and interest. But again, you're financing the whole purchase price. So interest only payments, at 4%, 5%, whatever that looks like on a $100,000 property, it's still going to be up there kind of high. So I really don't think that's a great benefit, but you will have a little bit higher cash flow because you've only got interest only payments. Now, as a cash buyer, you typically have a lot more negotiating power. What that means is that if you go to a property, you go to a seller and you say, hey, I'm willing to pay you all cash for this property. I can strike a check. We don't have to go through all of these headaches and loops with a traditional lender. I've got the money right here. It's a quick closing. So that seller, they don't have to worry about realtor commissions. They don't have to worry about, some of the traditional transactions that take more time. They don't have all the contingencies for inspections, appraisals, all of these kind of things. They don't have those, but they could hurt you in the long run. So if you waive some of that stuff to get a lower purchase price, you could pay for it in the long run. But it does give you a lot more bargaining power. So you can get a lower purchase price just because you're an all cash buyer. Unfortunately, in this market, there's a lot of all cash buyers. So that does really depend on the time in the particular cycle that we're in. Right now, there's a lot of cash buyers out there. So, doing an all cash purchase may or may not be in your best interest. One other benefit is that if you are buying, basically all cash, this is not going to show up. This transaction will not show up on your credit report. There's no background check, no credit check. Basically, it's just you and the seller in a transaction. The two of you are working the deal out. You may be saying that doesn't sound bad. I can get the property cheaper. I can go into the deal and negotiate a lower price. It's going to be faster. It's not going to show up on my credit check. But on the other side, that one property is going to get tied. It's going to tie your cash up for a while. What I mean by that is when you purchase that property and you try to refinance it, because the only way you're going to get your money back out is to refinance it. And when you go to refinance it, you have something called a seasoning period. Now, the seasoning period is basically where the bank says that you've got to own this property for a certain amount of time before we will allow you to refinance it. So anytime you buy a property all cash, you want to refinance it so that you can get your money back out and buy another property. The name of the game is to build cash flow, to build the number of assets that you have. Buying one property is not going to help you. It's not going to allow you to retire. It's not going to make you rich. You're going to need to own lots of property. So you want to get as much property as you can. It's kind of like when you play Monopoly. You didn't go around the board and just buy one property and just hope that everybody landed. You wanted to buy more property so that every single trip around the board, people were paying you. That's the same game we play here, right? So, but you want to be able to buy as much property as you can. But if you get stuck and trapped into the seasoning period, then the seasoning period means you might have to wait at least 6 months, sometimes upwards of a year before you can refinance and buy another property. So that's one of the big reasons that I like the first option of using your HELOC to essentially fund down payments. Now, fortunately, in my example, when I paid all cash, I had enough money in my HELOC that I could keep going. So I was able to, buy that property all cash, get a great deal on it, let it go through a seasoning period, refinance it, pull my money back out and do it again. But if all you got is a limited pool of funds and your purchase price is going to eat up your whole HELOC, that's probably not the best way you want to do it. So I personally prefer to use the HELOC for down payments, and that allows me to buy more property faster. That is exactly the strategy that I've been using throughout my business. It helped me to get started. I probably bought, probably my first 5 properties just on HELOC funds alone. So again, using the down payment allows you to maximize leverage, allows you to build your portfolio faster, and it's definitely the way to go. I totally recommend it. I've used it. I think it's a great tool. Both tools are great, but I think that the one that has the clear advantage is using the HELOC for down payments. I pray that today's video has been a blessing for you. I do want to pray with you real quick as you're looking into what you're going to do with your HELOC. If you're trying to decide on whether or not it's the right thing to do, trying to figure out how to use your funds. But I just want to pray with you, if nothing else, just to be a blessing to you. You're a blessing to me by taking your time out to watch today's video. But I want to pray with you and just pray God's blessing over you and your family. Let's look to God real quick. Father, thank you for this time to go over this video. Thank you for everyone who's tuned in. God, I pray for them and their families. Lord, I pray for their health, their strength. Pray for their confidence, their learning, their growth. I pray you open up doors of opportunity. And Lord God, I thank you for those who are tuning in and those who will continue to watch in the future. Help us, God, to I pray you build our faith and also to build our finances. Bless us to be a blessing to others. In Jesus' name, amen. Hey, thanks for tuning in, guys. I really appreciate you. If you haven't done so yet, make sure you hit that subscribe button. Make sure you hit that like button and then share this video with someone else who needs to hear it. I can't wait to see you again soon. Take care of yourself. God bless.